Well, energy media readers, you have probably heard in the past week or so Alberta Premier Jason Kenney talking about how the Saudis and Russia are engaged in a oil price war that is predatory dumping. Now, I interviewed an international trade expert today who disagreed with the Premier about the need for a closed North American oil market. And today we're going to be talking to economist Ed Hurst from the University of Houston, who's going to argue on the other side, who's going to argue that that is a good thing. So welcome to the interview, Ed.
Thank you, Markham.
Now, I know you've been a longtime advocate of import quotas to keep foreign oil out of the U.S. market. So give me your take on Premier Kenney's idea of a closed North American market, cooperation between the U.S. and Canada.
Well, Premier Kenney has probably read our paper, Crude Oil Imports and National Security, that we posted in 2010, where we called for exactly that, a North American market with Canada, the U.S., and Mexico basically acting as a producer-consumer market. Our argument at the time was that this would insulate the three nations from outages, supply outages across the globe. For example, the Strait of Hormuz, which, if it were blocked, could increase the price of oil to 300% in our estimates. And also to protect the domestic industries against predatory pricing, which is exactly what we've had now, what we had in the price war for 2015 and 2016. So it can be done. It was done. President Eisenhower had installed an import quota in 1959. That's what led to the founding of OPEC. And during that period of time, oil in the United States was roughly double the world price. So, it's been done. We've put together the economic study to show that it could be done.
Now, Professor Rees argued that, in fact, what the Saudis and Russians are doing is not predatory pricing, which he defined as selling for below the cost of production. And I think the Saudis are down around $5 or $7 a barrel. So presumably they are not selling below the cost of production. What's your take on that argument?
Well, yeah, technically dumping means you're selling for below cost. And certainly the Russians and the Saudis are not doing that. They're making money on their oil. Is it predatory pricing? Well, to the extent that any competitive market is subject to someone coming in and pricing their product below yours, yeah, that's predatory pricing. But again, they are low-cost producers. And for U.S. producers and some Canadian producers, they are the high-cost producers in the market. And they've always been vulnerable to this type of competition.
Well, now what happens, let's say a hypothetical that Canada and the USA are able to put together this deal, and there has to be consequences. For instance, US is already a large-scale LNG exporter. Canada wants into that business. Canada wants, is building the Trans Mountain Expansion pipeline to the West Coast so that it can tap into Asian markets. Seems to me that if you block countries from your market, that you invite trade retaliation. How do you respond to that?
That's absolutely true. To the extent that the nations rely upon exports, yeah, absolutely true. But for example, the United States today consumes about 18 million barrels a day, of which Canadian imports make up about 4 million. US production's about 12 and a half, maybe 13 last month in a pre-virus world. So that means we're still net down oil. And so we need, and plus the United States now exports about 3 million barrels of light oil that can't be used by the domestic refineries. Had the US maintained its export ban in 2015, that oil would now be refined by domestic refineries. They would have had the economic incentive actually to retool, to configure, to process that.
If, in fact, the the two governments took your advice and created their own cartel, OPEC 2, then what effect would that have on the American shale producers if it propped up prices? Would they be profitable?
Oh, absolutely. It would certainly prop up the U.S. shale producers. Our domestic cost of oil would increase, and it would give our refineries an opportunity to go ahead and retool. We're seeing this to a certain extent with a major. ExxonMobil is doubling the size of its Baytown refinery to handle the light crude that Exxon is producing at the wellhead in the Permian Basin. Keep in mind that since 9/11, the United States has spent about $6 trillion on wars in the Middle East. There are over 6,000 dead and 50,000 wounded. This is what we have paid to maintain cheap oil from the Middle East. President Trump laid that out very clearly and specifically in 2018. And again, just a couple of weeks ago when he said, low oil prices are a boon to consumers. He equates it to a tax cut. This is going to run counter. We absolutely know that any import restriction would raise the price to consumers at the pump. That's, of course, poison to any politician, Democrat or Republican, and the same in Canada as well. But given that this would give us a better chance to get out of the Middle East, I think it's a good trade.
Here's a corollary benefit that maybe, I don't know if you've considered, but if you're going to raise the price at the pump, essentially what you're doing what a carbon tax does, and presumably you would see less consumption of gasoline once those prices are higher. The U.S. doesn't want to put on a carbon tax. Is this a good substitute?
Well, it would have the same impact, raising the price of internal combustion engines and the operation of them. And to the extent that they would become more expensive than electric vehicles, absolutely, it would encourage a shift towards alternative fuels and alternative transportation.
Ed, thank you very much for this. I have no doubt that we're going to be seeing you again in the near future, because this is a very hot topic and going to get hotter in Alberta. So thank you very much.
My pleasure. Stay safe, Markham.